My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make you a little money. My job is not just to entertain you, but to educate, teach you. Call me at 1-800-743-CNBC or tweet me, Jim Cramer. Own NVIDIA. Don't trade it. That's been my mantra for ages now, and it's one of the best calls of my lifetime. After this magnificent run to just under 1,140, up another 7% today, well, maybe you got to start wondering, is it just luck? Did my travel trust simply get caught up in some sort of crazy maelstrom? After a day when NVIDIA really did define the trading, Dow declining 217 points, S&P inched up 0.02%, tech-laden NASDAQ gained 0.59%. It's worth looking at NVIDIA and asking, is it too much? Or, as the bears would put it, enough already! Now, there are at least two schools of thought about NVIDIA. There's one of the Rigor, one of my favorite analysts in the stock, that's Ben Reichs from Melius Research, who put out a piece this morning titled, NVIDIA shares still pack a lot of value, end quote. And then there's the momentum analysis from Dan Fitzpatrick, a technician who nailed NVIDIA better than most. Of course, given how long we've owned this one for the Travel Trust, I have my own opinions. I love NVIDIA. Why? Because it remains an intellectual powerhouse run by the smartest person I've ever met, Jensen Huang. More than a decade ago, he traced out what could happen with accelerated computing and artificial intelligence. He knew he'd develop super-fast chips that could do amazing things, including human-like inference and human-like learning. What I didn't realize when I first met Jensen was he was obsessed with the concept of speed, the speed you need to run cutting-edge video games since 1993 when he co-founded the company. At one point, Intel considered going against NVIDIA, but they weren't interested in the graphic cards business, staying focused on old-fashioned central processing units. Ultimately, graphic cards ended up having much more computing horsepower, to the point where they now do a heck of a lot more than graphics, and Intel, on the other hand, no. Back in 2008, CNET wrote this terrific article entitled, NVIDIA CEO Details His Beef with Intel. This is 2008. As Brooke Crothers wrote back then, I'm going to quote, NVIDIA is the largest graphics chip company in the world with quarterly revenue in the $1 billion range, end quote. Now, to give you some perspective, NVIDIA just reported a $26 billion quarter. The Intel rivalry I find instructive. As Crothers put it, quote, Intel is a chip manufacturer. NVIDIA is not. It's a fabless company. Intel supplies the central processing unit, a general-purpose processor. NVIDIA supplies the graphics processing unit, a special-purpose chip. End quote. I love this historical piece, so let me creep a little further. Huang is relentless in driving GPU performance and fearless when challenging Intel. This is admirable, if anything. Even the world's largest PC makers treat Intel with great deference publicly because the chip maker is so instrumental in supplying and defining the core electronics in their PCs, end quote. Then he goes on to say, but Huang will tear into Intel when he thinks it's warranted. And Intel may have reason to be worried about the content of Huang's candor. Despite Intel's colossal size and clout, NVIDIA, not Intel, supplies the defining chips for the most savvy users, game enthusiasts, end quote. Intel's market capitalization now, $132 billion. NVIDIA, $2.8 trillion. As it turns out, the computing speed that made NVIDIA a powerhouse in gaming eventually did indeed make it the key to artificial intelligence. Of course, that didn't mean NVIDIA could do no wrong. Not long after that 2008 interview, NVIDIA actually flamed out in mobile. But it never lost its need for speed, and Intel never cared enough to truly compete on that one particular area. I point all this out because Jensen Huang's been thinking about how to create lightning-fast chips for decades. Chips so fast they can, when bundled together, mimic human thought, except smarter. And that's why NVIDIA now pretty much owns AI, and AI owns the future. Now, that's not what Ben Reichs from Melius is saying in the bullish piece he published today. He's talking about how NVIDIA has a roadmap for dominance in its business, to the point where it became the premier growth company of our year. It will have a huge free cash flow, more than $240 billion over the next 3 years. He says it's attractive when you compare its price to earnings multiple to its growth rate. It's got amazing gross margins, in part because there's no real competition right now. So the stock will probably turn out to be cheap. Listen to this, quote, we argue it is worth paying for, end quote. Couldn't agree more. There's plenty else that's mentioned in this report, including analogies to Apple, some of the richly valued enterprise software plays. Hey, by the way, it's not just Righteous that I value so much on the fundamental side. Stacey Rascon from Bernstein has been adamant that you need to own NVIDIA, in part because it's relatively inexpensive for its growth trajectory. I use that word. Something he made clear when he was on Scott Wapner's Closing Bell show tonight. Inexpensive. He's nailed it, too. Now, to give you another bullish perspective, Dan Fitzpatrick, the founder of Stock Market Mentor, host of his own podcast, The Fitz Factor, regular off-the-charts contributor, has a lot to say about NVIDIA's fundamentals, but its chart, too. As he puts it, quote, if you think that AI is about to peak in development, then NVIDIA is overvalued by a mile. But if you think that AI is still in its infancy, then investing in anything other than NVIDIA is the key to underperformance. I love that. Currently, the street's average price target stands at $1,174, about 3% above where the stock's now trading. Fitz calls that analyst malpractice. Yes, malpractice. His 52-week target is 2,000 or 200 after the coming 10-for-1 split. As he puts it, I think there's a high probability that it will hit that print before the ball drops in Times Square. Don't you love this? He goes, this is the chart word. Yes, sometimes it is this easy. When the fundamentals are ridiculous, even numbers are the only reliable metric. Even numbers, like even odds kind of thing. Look at this, 1,000, 2,000. Pretty simple, right? How does he get there? Take a look at the weekly chart. Ever since the stock broke out above 500 in January, it's more than doubled. Amazing. Fitz thinks it's merely the first leg of the run. And based on the sheer power of this thing, he's betting it can double again by the end of the year. For him, this is a depiction of AI's future as much as NVIDIA's future. And we're taking a look at the same chart, but with some different verbiage. Up 100% from one even number to the next. Lather, rinse, and repeat. Keep it simple, right? All right, his coda. It's one thing to try to catch up to NVIDIA, but when you're trying to catch a leader that keeps growing exponentially, the task becomes really impossible. This is a chart of a nascent industry, he points out, not something that's a result of anything NVIDIA specific, other than its ability to make the best chips. So what he really is saying is this is not NVIDIA, it's AI, and NVIDIA happens to embody and embolden it. How about both of those? Where do I come down? In the end, while NVIDIA is a great company with a great stock, in the end, it's still a stock. That means there are other inputs besides the fundamentals for NVIDIA to go higher. It needs fuel, but there's not enough money coming in to keep the rally going. You saw the other stocks go down today. Almost everything save Qualcomm, AMD, ARM Holdings, and Dell, all AI plays, seem to be for sale today, didn't they? Perhaps some money managers can raise enough money to keep buying NVIDIA. Hard to imagine this $2.7 trillion company doubling in value without crushing the rest of the market, because the money's got to come from somewhere. I think that happens early in the day. I don't know. I saw the market up really big at 5 a.m. for what it's worth. Plus, valuation depends on inflation. Just because NVIDIA can spew cash doesn't mean we're going to value that future cash as much as we do now. In other words, even NVIDIA stock is not immune to the tug of the overall stock market, even it. And I should also add the bond market. And that's why, you know what, you've got to be, let's say, cognizant that the stock can come down a little and might be a better opportunity to buy. Bottom line, the buyers haven't repealed the laws of what governs the stock, even if that stock is NVIDIA. I agree with Fitz. I agree with Ben. I agree with Stacy. That doesn't mean I agree with the most bullish projections that they're giving. For me, it means own NVIDIA. Don't trade it. Let's go to Ross in California. Ross.
Booyah, Jimmy.
Booyah, Ross. What's up?
Lately, you've been talking about stocks like Getty Images as a play to license out their data for generative AI, and obviously Reddit just did that deal with, I believe it was Alphabet. Thinking in that vein, I'm wondering what you think of Yelp, since they've been compiling data for the last 20 years, people's reviews.
They have. But they don't have earnings momentum, and I don't want to key on that. By the way, just so you know, I mentioned indeed that Getty Images, and it's not been a good run there either. I've got to be very careful about what I think can do better and not from AI, and I'm going to say that Yelp's in the not category. How about Leo in Texas? Leo.
Hey, Jim. Thanks for taking my call.
Quite welcome.
Long-time fan.
Thank you.
Just wanted your opinion on Astera Labs.
Astera Labs, I like Astera Labs. It's a little high. I think that a lot of the newer companies that have come public are still involved in a halo. This one started to go down today. Let's let it come in. There's a little too much halo to the new IPOs. They are all trading at very high levels right now. Let's go to Leon in Pennsylvania, please. Leon.
Good evening, Professor Cramer.
How are you?
Due to the lackluster performance in the stock over the past 3 months, should I be concerned about Blackstone?
The stock does not act well. That said, I know that there's value there, and I think you have to be willing to recognize that this stock could be down 10, but the value continues. Jonathan Gray's doing a great job. They own a huge number of companies. By the way, they own a data center business that is just second to none, frankly. So I say hold on to it, but be prepared. We're in a rocky moment for private equity right now. Okay, look. Even NVIDIA's stock is not immune to the tug of the overall stock and bond markets. We can't exempt it, we can't asterisk. It's just true. That's why I think maybe buying it a little bit lower it could be a better way to go. Now, on Mad Money tonight, the aforementioned NVIDIA is at long last giving us that 10-for-1 stock split. So why have I been such a proponent of this move? I'm looking at some recent splits and sharing how it could impact your investing thesis, and it will. Then, from brown shoots to today's strong consumer confidence number, the economic indicators in this tape can give you whiplash. So how should you approach these mixed signals? I'm going off the charts in the S&P 500 to see where the major index could be headed. And Cloudflare reported a good quarter at the beginning of the month, but the street sure wasn't pleased with its guidance, sending shares lower. So are investors getting a buying opportunity ahead of what's going to be a very big analyst meeting? I'm getting the bottom of it with the CEO, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Last week, NVIDIA announced a 10-for-1 stock split on top of its fabulous quarter. Now, this is something I've been begging for since I spoke to CEO Jensen Huang at that GTC event back in March. Back then, he said it wasn't the right time to make any announcements. But he also agreed that splits are a good thing because they make it easier for employees to own a piece of the company. Take a look. So I'm going to ask you again, as I thanked you for many people, 150 people I saw this weekend who all told me, please tell him thank you. They all also want something that I know is pedestrian and doesn't add value. They want a stock split. Why can't you give it to us?
Well, we'll think about it. Today is not the day to announce it, as you know.
No, I know it. And again, I apologize it's meretricious.
Yeah, we've done stock splits in the past. One of the things that I really like about stock splits, by the way, is that it makes for the stock purchase for our employees and others.
Yes. That's what Walmart says, too.
Yeah, it's a good thing. And we want to make sure that we take care of our employees. They do such an incredible job for us.
Delightful man. Just delightful. Look, of course, all the experts will tell you that splits are meaningless. In theory, there's no difference between a $1,000 stock of a company that's earning $25 per share and a $100 stock of a company that's earning $2.50 per share. In a rational world, as I said as much to Jensen, splits shouldn't matter at all. They're not value creators. But we don't live in a rational world. And that's why splits do matter. They make great stocks that have run so much that they now have terrifyingly high price tags, feel more accessible to regular investors. Even though trading in fractional shares is now easier than ever, it just feels better to invest $114 to get a full share of NVIDIA, which you can do once the split goes into effect on June 10th. I think that's one of the reasons why the stock's run 20% since it reported last Wednesday. Again, maybe it shouldn't have. It did. That's the other thing about stock splits. Most of the time when they're announced, the stock goes higher. I know the skeptics will say it shouldn't work like that, but it does, which is why tonight I want to walk you through some recent case studies to explain why more companies should do this kind of thing. Now, just last Tuesday, one of my favorite companies, Lam Research, the semiconductor capital equipment maker, announced its own 10-for-1 stock split for $971 stock, along with a $10 billion buyback, amounting to roughly 8% of the company's market capitalization. CFO Doug Bettinger, he gave you the same rationale that Jensen gave you. It's Lam's employees, right? They want a better chance for them to participate in the company's employee stock plans. Now, Lam stock was already having a good year, up 20% for 2024, thanks in part to reporting terrific numbers in late April. But in response to the buyback in stock split, it finished last week up at 6.4%. For Lam Research, the last notable stock split came from Cramer fave Cintas. That's that uniform rental company that provides all sorts of other cleaning and safety services for small and medium-sized businesses. On May 2nd, Cintas announced a 4-for-1 stock split, which its stock currently trades at around $670. Once again, management said that they're doing this to increase accessibility for employees and other investors. Like with Lam Research, Cintas had previously reported a strong quarter in March that sent the stock soaring to the stratosphere. While the stock jumped 6.5% over the 3 weeks following the split announcement, it caught a tough downgrade from Citi last Thursday that caused it to pull back from $705 to $670, only $8 above where it was trading before we learned about the split. I didn't like that downgrade. Talked about it on Squawk on the Street. Made no sense to me. Still, it's clear the news was very positive for shares of Cintas in general. I think the downgrade-related decline is a blip, and the stock will get its mojo back by the time the split happens on September 12th. Take a look at that one. The most eye-popping stock split, of course, of the year was the 50-for-1 split that Chipotle announced in mid-March. That immediately sent the stock up 3.5% in a single session. Chipotle's now gained almost 13% since the announcement, fueled in part by a great quarter, by the way, in April. When we spoke with Chipotle CFO Jack Hartung on April 1st, he told us that the company had been thinking about a split for a while, but it never really made sense until recently. They're doing it to give themselves more flexibility when it comes to stock-based compensation. At the same time, Hartung said that a lower dollar price makes it easier for separately managed accounts to have an allocation in Chipotle shares. If you're trying to mimic the S&P 500 with a brain, but you don't have enough money to buy one share of everything, then the person in charge of your account will just skip some high dollar amount stocks. That means the 50-for-1 split means they no longer need to make that decision. Perhaps most important, he told us there was little to no pushback from professional money managers who usually hate stock splits because when institutions trade, they pay commissions per share. I remember hearing that answer, and I was quite surprised that there wasn't more pushback. Now let's talk about a major stock split that's already been enacted. On January 30th, Walmart announced a 3-for-1 split, and it went into effect near the end of February. Again, CEO Doug McMillon wanted to make it easier for employees to own whole shares, not just fractional shares. Since then, Walmart's up almost 18%, although it's hard to say how much of the stock split, how much comes down to 2 strong quarters and a 9% dividend boost. Either way, if you bought Walmart to get a piece of it ahead of the 3-for-1 stock split, well, look, you did great. Congratulations. Now, to be crystal clear, a stock split does not guarantee gains. There was one other split announced this year from Cooper Companies. That's a medical products play, which was announced on February 15, went into effect the next day. The news didn't have much of impact on the stock, and it's now down slightly since the announcement. But more often than not, a stock split brings gains. Let's wrap things up where we started with NVIDIA. As Jensen Huang noted in our March interview, they've split their stock before. In fact, they did so recently in May of 2021. NVIDIA announced a 4-for-1 stock split. Stock jumped 2.6% the day we learned about it. And by the time the split was enacted on July 20th, NVIDIA had rallied 28.5% from the split announcement. The stock continued to move higher for several months from there, more than doubling before it eventually topped out in November 2021, along with virtually every other growth stock, because that's when the Fed declared war on inflation. Still, between the announcement and the split, you would have racked up 28.5% gain in NVIDIA the last time they did this. Well, people have to be thinking, why should this time be any different? So let me give you the bottom line here. In theory, stock splits, they shouldn't matter at all. But if you just look at the stock splits that have been announced, including the ones we just went over, they clearly don't hurt. And for reasons ranging from the improved access to shares for employees and small investors to the halo effect they seem to have on share prices, let's just say I agree with Jensen Huang. Stock splits, good thing. Bad money's back after the break.
Coming up, a decisive moment ahead for the S&P 500. Cramer goes off the charts. Next.
All right, what do we do with this market now that we keep getting confusing economic indicators, a lot of brown shoots, but the occasional sign of strength like today's consumer confidence number, all of which makes it harder to predict what the Fed's next move will be? What do we do now that we've seen back in a world where tech is back in the driver's seat while the rest of the market's fallen behind? We've gone from Dow 40,000 less than 2 weeks ago back to Dow 39,000 now. In a moment like this, I like to take a step back. I put my own opinions about the economy to the side, consult something less subjective, something more empirical, more quantitative. And that's why tonight we're going off the charts with the help of Jessica Inskip. She's the first woman on the active trader desk at Fidelity, who's now director of product and education at Options Play, as well as the co-host and founder of the Market Maker podcast. Now, back on April 10th, she told us that the large cap growth stocks were about to come back in style in the Wall Street fashion show after spending a month in the doghouse. And she absolutely nailed it, okay? Completely. Because big cap growth bottomed a little over a week later and then came roaring back. So what does she see now? All right, first take a look at the daily chart of the S&P 500. At the moment, Inskip's noticed something ominous here. It's what's known as a bearish engulfing pattern. This is something that signals the potential end of an uptrend, which is not what we want to see. A bearish engulfing pattern is what happens when you get a big down day, so big that the candle on the chart engulfs the previous move higher. In the case of the S&P 500, back on Thursday of last week, okay, just not that long ago, Institute says the meltdown engulfed the previous 5 days of trading, creating a major area of concern. So you can see where we are. And the S&P ultimately found a floor of support at 5250. Okay, well, that's about our break there. Right around the level where the index gapped up to back on the 15th. The top of the gap also coincides with 5,265 support level formed back in March when the index peaked there. So you can see what she's doing. She's going back. So a lot of activity in this level. Engulfing pattern. Long story short, if the S&P can hold above this 5250, 52.65 area. Then Inskeep believes we're set up for a continuation of the recent rally. But if we break down below that level, she says the bearish engulfing pattern wins. And the S&P risks falling to its next major level of support. Now, where's that level? Let's look at the next chart. Okay, take a look at this. This is the S&P longer-term weekly chart. On the weekly, you can see that the next major support level comes in at the 13-week moving average. And that means we're looking at the red line, okay, which currently stands at 5170. Inskeep feels much more confident about this picture, though, because in her view, the S&P's weekly chart remains in a bullish trading cycle. Thank heavens. What does she mean by trading cycle? Remember, Inskeep likes to look at the 13-week moving average, the 26-week moving average, and the 40-week moving average, because the standard unit of time in the stock market is the quarter, and that's about 13 weeks. As long as those one quarter, 2 quarter, and 3 quarter moving averages are sloping upwards and acting as floor support, then Inskeep says you got a bullish trading cycle. These are all positive signs because in the good chart, you want to see the price rising quarter over quarter. So as long as the S&P 500 hangs in there above 5170, okay, and we're still nicely above that, the 13-week moving average, she feels confident that we remain in bull mode, at least over the medium term. So we have to hold above these. To me, well, you understand her trepidation. This market is full of have and have-nots. So what if we remove the heavy impact of the mega caps from this picture? Don't forget, the S&P 500 weights its components by market capitalization. So the largest companies in America have massive influence where the index goes. To smooth that one out, get a broader view of the market, we look at the S&P 500 equal weight, which is a variation of the S&P where every stock is weighted the same. So NVIDIA and Microsoft and Apple don't overwhelm things. So check out the weekly chart of the S&P equal weight. Something we don't spend a lot of time, but Jessica does. Inskeep says there's a reassuring sign here, which is that the S&P equal weight maintained its floor of support at 6691. Now, see, that's here, okay? Which goes back to the higher high the index made way back in January 2022, which I just showed you. According to Inskeep, that's an extremely important level because it's marked the beginning of the decline as we met with rampant inflation and Fed's relentless rate hikes. It also happens to converge with the S&P's equal weights 13-week moving average, currently at 6681, giving us a stronger floor of support, which is really, really good news. 6691, 6681. Of course, that floor hasn't always held. When much of the market was selling off in early April, the index broke down below that level and experienced a hideous decline. But now it's back above water, so Inskeep's feeling more confident that the rally continues to broaden out. I know, yin-yang, it's okay. We got to continue to just, it's empirical what's going to happen, all right? Finally, let's talk individual sectors. Of the 11 sectors in the S&P, Inskeep notes that 3 of them are in a bearish trading cycle: energy, real estate, and consumer discretionary. Collectively, that's 16.75% of the regular S&P 500. The other 8 sectors remain in bullish trading cycle, though, meaning sectors representing more than 83% of the market. That's not bad, right? Obviously, tech is the strongest right now. But what about the weakest? No, it's not oil. Oil, a nice rally today. It's real estate. So now I want you to take a look at a weekly chart of the Real Estate Select Sector Spider Fund. And that symbol is XLRE. Not only is this the S&P Real Estate ETF in a bearish trading cycle, bearish trading cycle, with the 13-week, 26-week, and 40-week moving average beginning to flatten, but the 200-week, okay, now we're adding that. The 200-week moving average has been breached on the way down. So you're looking at that right here. It's been taken out. According to Inskeep, falling below this level tends to lead to more drawdowns for the sector. She says she can't turn bullish in real estate until the XLRE makes a weekly close above the 200-week moving average, currently at $37.18. Well, it would have to go all the way up here. That's pretty far, right? 1326 and 40-week moving averages start to act as floor support. Might not happen anytime soon. So here's the bottom line. The chart is interpreted by Jessica Inskeep. She says this could be a decisive moment for the S&P 500. She sees real risks in the daily chart. Sell. And while she still feels good about the longer term, buy. If we get hit with a nasty sell-off, that could change the whole picture. But as long as the S&P remains above its key support levels, Inskeep feels relatively bullish. And that kind of cautious optimism makes a lot of sense to me. Cautious optimism. Let's go to Ed in Illinois. Ed.
Booyah, Jimmy Chill, club member and your main man in Chicago.
Well, I like to have a main man in Chicago. I appreciate that. I needed someone. What's going on?
Hey, this interest rate sensitive stock almost fell to its 200-day moving average today. Jim, should I be adding now to my position in BLDR?
Oh,
or does this
my.
one have a lot more room to fall?
Oh, my, you know how much I like this company, but I've got to tell you, both commentary from Home Depot and Lowe's was not instructive, not constructive. And it makes me concerned that there is still another leg to fall here. Let's do this. Let's split the difference. 162, if it goes to 150, then Ed, let's do something. But we got to wait. Bat on shoulder. Let's go to Trey in Texas. Trey.
Jim, I consider myself a Cray millionaire, and I want to thank you for the life you've made possible for me.
Oh, man, thank you. It's been a long, darn day. That makes me feel terrific.
You know, there was a time when spending $160 on just 7 pairs of boxer briefs wasn't an option for me. And now nothing touches these cheeks but Lululemon. I also want to own the stock, but I pride myself on never overpaying for anything. That said, do we buy here or wait for a better price?
I'm still stunned about that insight into your boxers. But I'm going to try to put my head together, get some cranial firepower together, and just say to myself, we have to wait for Lulu to report. It's just, all the signs are that it's still too soon. And I got to tell you, I don't want you in Hanes or anything. I'm not doing the Gildan thing. But I do feel that there'll come a time to do Lulu, but that time is not just yet. I think we've got a little time to wait. All right, the charts as interpreted by Jessica Inskip suggest this could be a decisive moment for the S&P 500. As long as the S&P remains above its key support levels, Inskip feels relatively bullish, and that kind of optimism, well, it's cautious optimism. It makes a lot of sense to me. But below, what can I say, man? It is just crucial, all right? I didn't think this week was going to be as crucial until I saw her charts. Much more Mad Money ahead, including my exclusive with Cloudflare, symbol NET. Ahead of the cloud company's Investor Day on Thursday, I'm getting a preview of what to expect with the top brands. It's been a rocky stock. Then we've been spending a lot of time recently trying to gauge the state of the consumer. I'm sharing where I think we currently stand. It's going to be a little bit different from what you hear on air. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. What should we make of the pullback in shares of Cloudflare? Earlier this month, the connectivity cloud company delivered a nice top and bottom line beat, but its billings came in weaker than some expected. Management gave some what thought was a softer full-year forecast. Because we've gotten so used to great results from Cloudflare, the stock got clobbered in response, falling 16% in a single session, and it hasn't recovered much since then. This week, though, the company's looking to get things back on track with an Investor Day event on Thursday. Before that happens, I want to get you a sneak preview tonight with Matthew Prince, the co-founder, chairman, and CEO of Cloudflare, who just rang the closing bell here at the New York Stock Exchange. Mr. Prince, welcome back to Mad Money.
Jim, thanks for having me.
Okay, so Matthew, let's get right to it. Last quarter was a good quarter, and there was no flies on it, but there was a sense that you had some macro concerns, and that reflected in what would be a bit of a shade down. Any thoughts about what happened that day? Because it really was preserved. Somehow it came out as being that you were very concerned about the future.
You know, I think I am concerned about the future. I think anyone who's watching the news right now can't be super confident about the future. And I think we're in a unique position where we are, as somewhat a cybersecurity company, at the front lines of a lot of the global conflicts that are going on right now. And so we have a unique view into that. But in some strange way, as the world gets scarier, it's actually better and better for our business. So I'm concerned about the macro, but I really am confident about the future of Cloudflare.
Well, will you be, just give us a little sneak preview, will you be able to project stronger earnings, say, for next year because of what you see right now?
Well, again, I think right now we see a lot of uncertainty in the world, and I think we are always prudent in how we think about that. But the world continues to demand the connectivity cloud that Cloudflare that provides, and us being able to secure as much of the internet we do, where 20 to 25% of the web sits behind Cloudflare today. We are absolutely critical to making sure that the internet is going to function and perform for businesses around the world today.
Okay, I want to look at what the internet is versus what it should be. It came in, it was kind of a jerry-rigged thing. What should the internet look like in order to be more secure and be better connected?
Yeah, you know, the internet was a science project. It was never supposed to be successful. They actually had a second project, which was the secure internet, and it never went anywhere. And so we're stuck with this, again, kind of duct taped together thing. And Cloudflare's mission is to help build a better internet. When we say a better internet, we mean an internet that's more secure, more reliable, faster, more efficient, because it's amazing we have 4 billion people connected online, but it's shameful we have 4 billion who aren't. and also more private. So the work that we do with organizations to make sure that the internet is as private as possible, I think, again, is when we talk about a better internet, what we're talking about.
Okay, what you're talking about in general is, I think, what's most exciting about your business. Now, I remember you also having a big content delivery business, and that's up against Akamai and Fastly. Fastly had a terrible quarter. Akamai had a quarter where the security was very good, but the content delivery not so good. Where are you in terms of the way you would phrase yourself in what turned out to be a pretty difficult, almost zero-sum game, this content delivery business?
Yeah, we've never really thought of ourselves as a content delivery business. Okay. We've thought of ourselves as a connectivity cloud. How do you connect anything together? And in any computer science problem, caching is going to be part of it, right. Keeping a copy of something locally. But that's something we've given away for free for a long time. We've been the disruptor in that space, not even intentionally, just because you needed to make things fast around the world. But really core to who we are, and the reason why we're getting great companies relying on us, is that we're making the internet better on all of those different metrics. And that's again, just something very different than any of the other companies out there.
The way your business works, you have to constantly get new customers. I know you do land and expand the conference call. Are there enough customers out there, or is it just such a dogfight with some companies that are actually kind of wounded and I maybe making deals that you don't want to match?
Yeah, that hasn't been our experience.
Okay, good.
Our experience has been that landing great customers is something that we're continuously doing. So we, just are going to be featuring at our Investor Day Porsche Informatica, which is the IT department behind the entire Porsche technology systems. They need to make sure their cars, which are increasingly computers on wheels, are fast and connected everywhere in the world. And Cloudflare is powering that for them across the world. That's the sort of customer that we get. But what's also amazing is the innovation engine at Cloudflare. We're constantly releasing new products. And so the customers that we have are expanding and expanding and expanding, using more of our services, and we're effectively becoming their network, and that's a huge opportunity.
Okay, now on the Akamai call, and again, I'm here to talk about Cloudflare, not about that. But they did talk about losing a large social media customer. And I'm thinking, that's not really what you would be doing anyway, right?
Not so much. Again, I don't know the details of what Akamai is doing. And frankly, we don't really think about them. When we first started Cloudflare, there were only 3 rules. One was don't hire jerks. The second was don't ever lose on price. And the third was make sure not to go after any Akamai customers, because we saw that as a business that was in decline. Okay. Whereas we thought that the future was how do you actually build a better internet? And that's, again, what we've delivered at Cloudflare.
Okay, let's talk about something you're doing that is for the good of the people, but also may become very problematic come the election. You do the Athenian Project. It is just great. You have really made it so, look, elections are the most important thing that democracy's have. At the same time, we have a previous president, who has already said that the election's rigged if he loses. How can you demonstrate that that's not the case, or is that not, and you're not going to get the call to be able to do that?
We can't solve every problem around the elections, but we're sitting here on the floor of the New York Stock Exchange, really one of the foundational institutions of the United States. Democracy, we couldn't have built Cloudflare if we didn't have a stable functioning government. And so I think all technology companies, when they have the ability to do something to protect election infrastructure, it's our responsibility to do that. And so we started the Athenian Project after we saw what was, again, a lot of foreign interference, a lot of cybersecurity threats in 2016. I'm actually proud that even with all of the challenges around the 2020 election, cybersecurity wasn't the issue. And Cloudflare, along with other great companies like Microsoft and Google, really stepped up to volunteer our expertise and our technology to make sure the election is secure. And we have a team which is standing by, giving our services away at no cost to any election official in counties, states, anywhere in the world. And I'm proud of the fact that more than half of U.S. states today are using Cloudflare technology to make sure elections are secure. And we want cybersecurity not to be the part of the story. That doesn't mean there won't be other challenges in the election, but the part that we can help with, we think it's our duty to actually make that secure.
Okay, and then finally, again, just a little bit of skirt up on what's going to happen on Thursday. What are some new initiatives that you might be thinking about? You don't have to, I know you want to unveil some big things, but maybe just give our audience something to preview.
we bundle our investor day with our user conference. It's amazing to see all of the customers of Cloudflare come together. And I think one of the areas that we're really excited about is that what we're doing with AI. We think that AI, fundamentally, the inference part, that after you've built the model where you use it, that's going to run on networks like Cloudflare. And so we've rolled our inference capability out to more than 150 cities around the world, making sure that it's fast, reliable, secure, and can be local, so that whatever you're doing, wherever it is in the world, that AI feels like it's actually a person standing next to you in whatever culture or whatever location you're doing. There's nowhere else you can do that other than Cloudflare, and we really are proud of the work that we're doing.
I wish you the best of luck. Congratulations on ringing the closing bell, and it's a big couple of days. A big couple of days for Matthew and for Cloudflare. That's Matthew Prince, CEO and co-founder of Cloudflare, and the symbol is NET. And I hope you heard enough. Take another look at the company and the stock. Mad Money's back after the break.
Coming up, hit us with your best shot. An electrified fast fire lightning round is next.
It is time for the lightning round. Golden numbers. I said buy, sell, just be good. Another course. Stock questions. My stand first. You plan this out. And then the lightning round is over. Are you ready, Ski Dad? Time for the lightning round. Let's start with Rico in Massachusetts. Rico, what's going on?
Hey, booyah, Jim.
Booyah.
I want to ask you about a stock that recently got clobbered once it reported earnings, but it has been rebounding since. And I want to know what you think about it for a long-term trade at these levels here. That company is Datadog.
Okay, I want to see what Salesforce reports tomorrow because Workday was not as good as I'd like. If Salesforce is not as good as I'd like, then Datadog is going to go down. Let's hold off for a day. Let's go to Gene in Illinois. Gene.
Thank you, Mr. Cramer, for taking my call.
Of course.
I hope you and your loved ones are healthy and safe.
You're very kind. All good. I hope safe. What's up?
I'll cut to the chase because I know you're a busy guy. Excelis Technologies, symbol ACLS.
You can tell me why that stock is going down. That company is a very good semiconductor company that's been left behind. I find that very interesting. Let's go to Greg in Ohio. Greg.
Hey, Jim. This is a first-time, long-time caller.
Okay.
A recent club member. I'm wondering what you think about ticker symbol TGNA.
All right. Well, I do hope that you'll be on our club meeting on Thursday. Should be a good one at noon. This is TV stations, and I just don't care for anything involving linear TV. It's just not where I want to be. I'm sorry. I mean, maybe good for others. Let's go to Rocco in New York. Rocco. Rocco, how are you?
How's it going, Jim?
I'm doing well. How about you, Rocco? What's going on?
So I'm looking at iPhone sales, and they're up at 52% in China year over year in April. And with that and the AI announcement hopefully coming and the Worldwide Developer Conference in June, I'm wondering what your prediction is for a 5 to 10% bump in Apple stock price.
Okay, well, I don't know if you can get that much, but Apple was up $2.30, 40 cents at 5 a.m. on this news, and then it just proceeded to give up the ghost the whole day because the rest of the market was under a lot of pressure from interest rates going higher because of an auction, and also because people were funding their NVIDIA purchases. I think Apple is a buy here. I want you to own it. I don't want you to trade it. Let's go to Nick in Florida. Nick.
Hey, Jim, how are you today?
I am good. How about you, Nick? What's up?
I'm calling about NVO. Is it a good growth stock?
NVO is a good growth stock, but I like Lilly better because Lilly may have, and it hasn't happened yet, a little bit of a kick from another drug that it's working on involving dementia. And I sure hope that they solve it, but they haven't come. We've not seen anything about it, but I know it's in the pipe. Let's go to Sal in New Jersey. Sal.
How you doing, Jim? I'm a first-time caller, long-time listener, all the way back to the days of Carlos and Cramer show.
Long time. What's up?
Thanks for all your common sense advice over the years. It's been very helpful. Appreciate that. My question is about Bristol Myers Squibb. They have a good pipeline of drugs and a 6% almost dividend. What do you think about?
Well, I think that you're going to be paid to wait for things, but it's going to be a long wait. And if I want to be paid to wait, I'd rather be in Pfizer than I would be in Bristol Myers. Let's go to Matt in Massachusetts. Matt.
Hey, Cramer. Thanks for having me on.
Of course.
I think I dredged up a really good one for you here. GLDD, Great Lakes Dredge and Dock. 2 straight big earnings beats.
I have not looked at Great Lakes Dredge and Dock since I was like a toddler. I am going to have to do some work on that one. I used to be one of my favorite stocks because I just liked saying the name. That's not good enough around here. Let's go to Gary in Nevada. Gary.
Hey, Jim. Thanks for taking my call. I appreciate it.
Absolutely. What's
I'm
up?
considering adding an investment management company to help balance out my portfolio. So I wanted to get your thoughts on T. Rowe Price.
I think T. Rowe Price is such a bargain, and here it is. You get a 4% yield. It has done so many good things for so many investors. I'd love to join you in owning that one. I think it's a great idea. Let's go to Eddie in New York. Eddie.
Hey, Uncle Cramer.
How are you,
man? I appreciate you breaking it down for everybody, listening to your opinions. It's like having an uncle in the business, my man.
Oh, thank you very much.
You're welcome. I was wondering, what's your opinion on Palantir, which has been hovering between like 21 and 23 most recently,
Well, I think here's the problem. I know the consumer package goes up, but it's very tough to understand what they really do for the government. So therefore, I am no longer going to say that that's a stock to own. I can't figure out what they do. And that, ladies and gentlemen, the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, is the case of the consumer as simple as haves versus have-nots? Cramer tackles an age-old question. Next.
We spend an awful lot of time around here trying to figure out the true state of the consumer. The data points are all over the place. She doesn't want to buy a $9 Big Mac, fries, and Diet Coke. She wants Cereal Boat Special at Texas Roadhouse, just north of McDonald's. We find out the consumer can even afford Bloomingdale's or Lululemon rather than trading down to Kohl's and Gap's Athleta. Yet last week we learned that Bloomingdale's is doing great. But there really is no conundrum here because there's no such thing as the consumer. There's simply a major divide between the haves and the have-nots in this country that explains nearly everything about the situation. It's not new. As F. Scott Fitzgerald wrote, quote, "Let me tell you about the very rich. They are different from you and me," end quote. Still one of my favorite lines from a great book. That was back in 1926. The rich really are different, but the big difference between 1926 and now is there are a lot more rich people these days. For a variety of reasons, we have a huge assemblage of ultra-rich people in this country, and their spending habits obviously don't have a lot in common with the middle class. The wealthy do not trade down. They're not going for the $9 hamburger, let alone Taco Bell's surprisingly cheap $5 taco Discovery box. They're lost. TJX isn't part of the routine, nor are Burlington or Ross stores. The rich aren't interested in do-it-yourself home renovation. They may not even know what DIY stands for. They want a contractor to do it. Now, it can be confusing. The rich don't throw their money away. They won't sacrifice the house they bought for cash or with a 3% mortgage to move into a new home with a 7% mortgage. But if they've got enough cash to buy it outright, they're willing to get into a bidding war for the right home. They likely have two houses at a minimum, the latter often worth more than their home base, perhaps because it's in a lower tax jurisdiction. They throw off the whole discussion on the cost of shelter because they don't seem to mind paying up for something that the non-rich would balk at. Why does any of this matter? Because we're wasting our time trying to figure out the aggregate consumer's mood or desire to spend. The non-super rich are more frugal. All but the mass of the universe are worried about inflation and want it stopped. Even the super rich find that they don't have as much flexibility to do the things they want to do in business thanks to higher interest rates. But in terms of personal consumption, the haves and the have-nots, well, they have very different habits. And trying to average them out, it gets you nowhere. Now, I'm making vast generalizations here, so don't take me too literally. But any talk of the consumer is an even worse generalization. I just want to stop the conversation about how the heck a cash-strapped consumer can still take elaborate trips and buy expensive homes and fly first class. The haves can afford that stuff, not the have-nots. Because as Fitzgerald put it, the rich are different from you and me. Or as Ernest Hemingway replied, yes, they've got more money. I like to say there's always a bull market somewhere, and I promise I'd find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.